Hi, Elliot. How you doing?
Good morning. How are you, sir?
Good, good. And Laura's back for part two. Wow. You're going to hear more about debits and credits today, Laura, huh? I like your spirit. Hey, Liam.
How you doing?
Hi, Liam. How you doing? Good to hear from you.
Yeah, same here.
All right. I guess we've got how many people? We've got four. That's about a small portion of the class, but I trust others are going to catch up to us. Here comes Camden. All right.
Hello.
Camden, how you doing?
Good.
How's my man named after South Jersey?
Yeah.
Okay. All right. Maybe wait another moment here and then we'll get into chapter three. Chapter three, we're really going to hit hard on the world of debits and credits, much like I just did in my 110 class, where they're kind of at the same level as you for about one more week, and then we really leave them in the dust. So, and Serena's joined us. Hi, Serena. Good to have you here. Okay. All right. I guess we got a pretty good crowd. Thank you. We've got 5 participants. And let me see if I can share a screen here. Okay. All right. Let me set this up my way. I did it my way. Okay, we got a nice long PowerPoint presentation for us today. I wish we were in the classroom where I could hand out assignments that you could work on while I walk around the room, but we'll work around that. So we got 5 things we're going to talk about today. We're going to talk about the effect of business transactions on the basic accounting equation. And we're going to learn about debits and credits. And we're going to talk about how journals are used and what a general ledger is and how you post, and then what a trial balance does for us. So let's see if we can get going here. Analyze the effect of business transactions on the basic accounting equation. Okay. Using the accounting equation to analyze transactions. We collect data, we process it, and we communicate it to the public, to our peers. Analyze business transactions, and then we journalize. Journalizing is the action that takes the data and puts it into the general ledger. Do it via what are called journal entries, which we post. And then at the end of the month, after we've written all these journal entries and we've done all our work for the month, we're going to run a trial balance, which is going to enable us to prepare adjusting entries and eventually the financial statements. So what you're looking at here is really like 3 chapters in one, and we're going to divide and conquer. So we're going to analyze business transactions. We're going to write up what are called journal entries. We're going to post those journal entries. We're going to run a trial balance, and then we're going to have a formal period where we adjust the trial balance, get an adjusted trial balance. Then and only then can we prepare the financial statements, the closing entries, and the post-closing information. So it's quite a lot. And let's, like I said, let's divide and conquer here. Accounting transactions, any economic event that requires recording. Not all activities require transactions. You announce to the world that you just hired a new president of the company. That's not a business transaction. That's not an accounting transaction. That's just a little PR for the company. Assets, liabilities, or stockholders' equity change as a result of an economic event. And we have a dual effect on the accounting equation. You must have at least one debit and one credit. And we're going to get to debits and credits shortly. Are the following events recorded in the accounting process? Purchased a computer. Purchased a computer. Of course, that's a transaction. That's a transaction where you're doing something. Discuss guided trip options with potential customer. There's no financial transaction there, and paying the rent, of course. So be aware that there are certain activities that have nothing to do with accounting transactions. The basic accounting equation, and I'm assuming we're seeing this for the first time. Assets equal liabilities plus stockholders' equity. I repeat, assets equal liabilities plus stockholders' equity. We know what assets are now, anything of value. We know what liabilities are, those are debts. Stockholders' equity would be the difference between your assets and liabilities. Assets equal liabilities plus stockholders' equity. This equation must always remain in balance. If an asset is increased, there's got to be a decrease in another asset or an increase in a liability or stockholders' equity. Take a peek at the expanded accounting equation. I'm not sure I like this presentation, but we work with it. Assets equals liability plus stockholders' equity. What is included in stockholders' equity? Two components that you're going to see on the balance sheet. You're going to see common stock and you're going to see retained earnings. And within retained earnings, you're going to see the revenues and the expenses, otherwise known as the profit, increasing retained earnings. Dividends will reduce retained earnings. Retained earnings is the account where you close out your net income statement into equity. You started a company today, September 1st, tomorrow, you start a company. You have no retained earnings because you haven't done anything yet. At the end of the first month, you got a profit of $10,000. That $10,000 profit is now sitting in retained earnings as an increase in stockholders' equity. The next month, you made another $40,000 in profit. Now the retained earnings has gone up to 50. So you get the idea what retained earnings is. It retains the net income every month. The only way retained earnings gets reduced is through dividends. If you choose to give part of the company away to shareholders in the form of dividends, that reduces retained earnings, okay? Let's go through some, I don't want to say simple, let's go through some examples just to get us comfortable with the accounting equation, and then we're going to get into the journals, okay? So here's our first transaction. On October 1st, cash of $10,000 is invested in Sierra Corporation in exchange for stock. So something has to go up. You have to have at least one. Let me say this more clearly. You have to have at least two accounts, double entry bookkeeping. You have to impact two of these things you see here. So we're looking at this. Cash was invested. So I'm thinking cash went up and so did common stock. And our equation remains in balance. Sierra borrowed money by signing a note. 12%. Wow. I wish someone would pay us a 12% rate, huh? 3 month, 12% note payable. So that means our cash went up, and
No,
so
down.
we borrowed money.
Oh, I'm sorry.
Yeah.
Yeah.
Yeah, good question. Now, Sierra borrowed the money from Castle Bank. So we're Sierra. We borrowed $5,000. So our cash went up and the debt went up as well. The liability. We're in balance. Sierra bought equipment for $5,000 cash.
So now cash goes down
There you go. Cash, there you go. Now you got it. Cash goes down.
and equipment up.
That's correct. There we go. Is that Susie? How you doing?
Yes, good. Thank
I
you.
don't see the faces right now. Here we go. Event number 4. Sierra received a $1,200 cash in advance from R. Knox, a client. This is a little trickier. Here, what we're talking here is unearned revenue, unearned service revenue. What happened here was a customer paid us in advance. So naturally, we record the cash as an increase in cash. but we have not done anything to earn the money yet. So this goes into an account called unearned service revenue, which is oddly enough a liability account. Seems incongruous, huh? We received cash of 1,200, yet we generated a liability of 1,200. The liability is not in cash. The liability will be paid when we do the work for Mr. Knox, our client.
Mhm.
Number 5. Let me fix something here. Hold on. There we go. That's better. Okay, number 5. They received 10,000 in cash for guides for services performed. Cash goes up. So does revenue. So does revenue. Cash and revenue both went up. Number 6. On October 3rd, Sierra Corp paid the rent. They paid the rent. Cash is going to go down. Rent expenses going up, up, up. Let's see what number 7 is. On October 4th, they bought an insurance policy for $600. When you buy an insurance policy, it is an asset at that time. It is an asset. It becomes an expense only when you get the benefit of the policy. So they paid for this policy $600, and I'm guessing that it's going to expire at the end of the next year. So they bought the policy for $600, and they're going to be expensing it off at $50 a month over the next year. When you buy the insurance policy, it's called prepaid insurance. It's a prepaid asset. They bought 3 months of supplies. When you see the word supplies by itself, that represents an asset. They bought supplies, $2,500 worth of maybe cleaning supplies, detergents, towels, whatever. Supplies, it's not part of your inventory. You're not buying and selling supplies, you're using them. And it's only when you use the supplies that you record the expense. So they bought the supplies on August 5th. At the end of the month, they're going to go out into the supply room and count up what supplies are left to figure out how much they used. They hired 4 new employees to begin work. There is no transaction here, number 9. No transaction. I wish they had said on the line 9, no transaction. Now they paid a $500 dividend. Whenever you pay a dividend, you are reducing equity. That's what a dividend is. You're giving away part ownership of the company to somebody else. And you will always, always debit retained earnings and credit cash. Here, what they did was they credited dividends, which is okay because that's going to roll up into retained earnings. Okay, so we reduce retained earnings via dividends for that $500. And then finally, the employees get their paychecks, $4,000. Cash is going to go down, and the expenses, yeah, goes up. Exactly right. So at this point, we are in balance. 23,300 assets equals the liabilities plus the equity. Let me bring your attention to the plus and minus signs here. Cash plus supplies plus prepaid insurance plus equipment, that is your 23,300. That's what equals. You just see something here. Yeah, get the final one. That's what equals the 23,300. Now you go equals notes payable, right, Susie? Plus
Yes.
accounts payable. Now here's where I really want to call your attention. You have a heading called stockholders' equity. That consists of common stock plus the revenue minus your expenses minus dividends, okay? So that's just a brief look at doing some transactions before we get into the accounting terms of debits and credits, okay? You keep the accounting equation in balance at all times. So let's see what we have here. A tabular analysis. Here they're just showing you in a different format how to lay something out. They want you to describe each transaction. Describe each transaction. Transaction 1, we debited cash. I don't want to say debit. We're not up to debit yet. In transaction
So
1,
we purchased common stock with cash.
we didn't purchase. We issued stock.
Oh, yes, I'm sorry.
Yeah, we
stock.
issued stock to the public, and the public paid us $25,000.
So our cash went up,
Yeah, that's how they raise
increased,
money.
yeah.
And the description, every transaction you write in the form of a journal entry should have a description. And it can be very, very short. Usually you can just use the words "to record" to begin. So the way I would describe this transaction might be "to record stock issue." And that would suffice. Let's look at the next one. Equipment went up and accounts payable went up. What happened there?
So equipment was purchased on account.
There you go. There's your explanation.
Yeah.
To record equipment purchase, and maybe say on account. Okay. There was no cash involved. The next one, cash went up 8,000 and so did revenues. To record sales.
So we provided services, probably.
There you go. To record provided services. That would be fine.
Yeah,
And
it
then
says
the
there
last-
with service.
Then the last one, we're just recording an expense. Let's
So
assume
we paid rent.
Yeah, so we just say to record expense, to record telephone bill. So we're going to get in the habit of using descriptions for transactions. And here's the descriptions that they're talking about. You see how short they are?
Mhm.
To me, they're even too long. First one, to record stock issue. Second, to record purchase. Here they're giving you very detailed. That's up to you when you get out into the work world. Now, what we just did here was some work using this horizontal worksheet. Now we're going to do probably the same transactions, doing them debits and credits, okay? Debits and credits, and this is going to trouble you for a while. This is a little bit difficult when you first get started. Some of it is counterintuitive. We have double entry accounting system. Every entry must have at least one debit and one credit. Every transaction must have one debit and one credit. You can have one debit and 100 credits. You can have one credit and 1,000 debits. As long as the debits equal the credits, you must have at least one of each. That's all. If the debits are greater than the credits, the account will have a debit balance. And we're going to go into some rules in a little bit. So transaction 1, this account was debited for $18,000 credited. So the balance is $15,000. Okay, $15,000. If credits are greater, then you just have a credit balance. Certain accounts always have a credit balance. Certain accounts always have a debit balance. And those are the rules that we need to understand. So let's get started here, okay? Procedures for assets and liabilities. Assets, debits should exceed credits, liabilities, credits, okay? We're talking about what's called the normal balance. The normal balance of an account is the side of the T account which increases the number. So here they're talking assets, cash. If we increase cash, we are said to debit cash for that amount. By the way, debit and credit mean only left and right. That's all it means. A debit is not better than a credit. Credit is not better than a debit. There's no morality here. One is just a nomenclature. So assets have a normal debit balance. Liabilities have a normal credit balance. What does that mean again? Assets go up with a debit, but liabilities go up with a credit to further confuse you, okay? Let's take a peek at stockholders' equity. Stockholders' equity has a normal credit balance. It goes up with a credit. And that brings us into our stockholders' equity details. Common stock is part of equity, so it is increased with a credit. Retained earnings are increased with a credit. Dividends are increased with a debit because that reduces stockholders' equity. Now, you're not going to learn these rules just in this lecture today. You're going to have to go do a little bit of homework, think about them a little bit until they formalize in your mind. Right now, this is going to be a little bit confusing, but let's work through it together, okay? Procedures for stockholders' equity. Well, we just looked at this. Stockholders' equity is a credit balance consisting of credits in common stock, retained earnings, got happy fingers, I'm sorry, and debits are an opposite. Revenues always increase stockholders' equity. Revenues increase stockholders' equity. When you credit a revenue, that revenue credit is eventually going to find its way up into stockholders' equity. When you debit stockholders' equity, when you debit an expense, that expense is going to work its way up into your stockholders' equity. The effect on revenue and expense account is the same as their respective effects on stockholders' equity. Let's say at the end of the year, you have $100,000 credit revenue and say 80,000 debit expenses. You're going to bring the credits and debits up into your stockholders' equity, and that number you bring up is your net income. Hey, I got excited when I saw the slide. I thought we were going to talk some baseball, but they're just giving you 3 revenue streams for the Chicago Cubs, huh? Player salaries, admin, concessions. Yeah, you go to Wrigley Field, you buy a $12 can of beer. Television and travel, radio, advertising, maintenance. Let's take a peek at our financial statements. Now, we think we did a little bit of this. We have a balance sheet. Assets equals liabilities plus equity. That's all that is. And we have an income statement. Income statement is simply sales or revenues minus expenses. We have to do the income statement first because we need that number to do the retained earnings statement. The retained earnings statement is simply beginning retained earnings plus net income minus dividends, gives ending retained earnings. And then when we have that, we can do the balance sheet. So understand that the financial statements must be done in a specific order. Income statement, equity statement or retained earnings statement, and balance sheet. Here's a good page to look at because this has everything in one shot. This is everything you need to have memorized. And I am going to say memorized. I hate to use that word, but you got to use this, learn this by rote. Assets, expenses, and dividends have a normal debit balance, meaning they increase on the debit side. Liabilities and revenues increase on the credit side. It's really not much when you think about it. It's just 5 different rules to remember. Assets, expenses, dividends, they go up with a debit. You like lemonade? A-D-E. A for assets, D for dividends, E for expenses. Those are your debits. If you remember those 3, then you know the other 2 are simply credits. If you learn only that liabilities have a credit balance and revenues have a credit balance, you know the other 3 have a debit balance. So we got to work our way through this tough information here. Here's some more information. Assets go up with a debit. Liabilities, assets go up with a debit. They go down with a credit. Liabilities go up with a credit and down with a debit. Equity, up with a credit, down with a debit. Revenue, the same thing. Up with a credit, down with a debit. Oops. Expenses, up with a debit, down with a credit. You think you can memorize all that, Susie? You're gonna have to. You're gonna have to. Here's another chart showing you, maybe you can study from this chart. Assets equals liabilities plus common stock, huh? Plus retained earnings, plus revenues, minus expenses, minus dividends. Let's look at it this way. Assets have a normal debit balance, right? Assets have a normal debit balance. Since assets equals liabilities plus stockholders' equity, liabilities therefore have to have a credit balance and equity has to have a credit balance. Assets have a debit balance, therefore liabilities and equity have a credit balance. And that equity consists of common stock, which has a credit balance, retained earnings, which has a credit balance, revenues, which have a credit balance, less expenses that have the debit balance, less dividends with the debit balance. The equation must be in balance at all times. When for every dollar of debits, you better have the same dollar amount of credits. Debits. Anybody want to take a shot at this question? Debits. Debits, huh? Debits. Well, we know they increase assets, huh? So we know the answer is probably going to be A or C. But debits don't increase liabilities, they decrease liabilities. The answer is C. That is a test question. You'll probably get 7 or 8 questions along that line come test time. Accounts that normally have debit balances. Debit balance. Debit balances.
So that would be asset, expenses, and dividends.
Yep, there's your lemonade. Assets, dividends, expenses. There you go. Now we've become experts in debits and credits, right? Now we're going to talk about how to use them in the journal, in the recording process. We are going to analyze the transaction and its impact or effect on the accounts. We're going to enter that information in what's called a general journal via what's called journal entries. And then we're going to transfer this information by posting to the ledger. So step 1, we analyze business transactions. We journalize the transaction. Journalizing means you write it down. It means you go into your computer system and you enter the information. You might have the electric bill in today's mail. You open up the envelope, there's the electric bill, you look at it. Yeah, that looks like a normal electric bill. That's about what the expense is every month. You put the electric bill down on your desk and you enter debit electric expense and credit accounts payable. That's called a journal entry. Then maybe you have a payroll entry. Question? Then you have a payroll entry and you enter the payroll. You debit wages expense and you credit wages payable, say. You do all these journal entries. You might do them every day. And then at the end of the day, you check them out and then you post. You post. And that is the posting is the action that permanently puts it on the general ledger. Posting. So here they're showing you a T account. They're calling it a general ledger, but okay. Look at your T account here. Cash had a balance. Cash, he opened up the company with $10,000, and then he bought some equipment or something for $5,000. Your balance now in cash is $5,000, and the balance in equipment. So you analyze what happened. We bought some equipment. We wrote a journal entry, which you're going to be seeing shortly, and then we transferred to the ledger. The general journal, also called journal entries. They're recorded in chronological order in a journal before they're transferred to the accounts. It contributes to the recording process. Journals disclose the complete effect of a transaction. You're going to see the debit, the credit, which tells you what accounts were impacted, and you're going to see your little tiny explanation. And it's a chronological record of transactions, and it helps to prevent or locate errors because the debits and credits can be readily compared. Journalizing, the act of entering the transaction data into the journal. Just entering it into the journal doesn't do anything but get the entry ready for posting later. By posting, I mean you hit a button in your computer that says post, then all of that information flows into your general ledger as a permanent record. So let's look at a couple transactions here. Sierra issued common stock in exchange for $10,000 cash, and then they borrowed money, and then they bought something. So let's see what they're going to show us. Take a look at the journal entry. This is the first time you're seeing a journal entry. Remember, we just did these transactions in this format. Remember, we just did this 15 minutes ago. We worked them out horizontally across the page. Here is how it's done in a regular business environment. You have what's called a journal entry. The top of the page, you have the year. After that, you don't have to worry about putting the year. You have the date. The debit always comes first, if you can. You should always start with your debits and then the credit. Notice that the credit is indented. That is super important. That is super important because auditors and people who work in business are trained to see that indentation. It breaks out the credits from the debits a little bit easier on the eyes. So what did we do here? We debited $10,000 cash
Went up.
and credited common stock. They both went up, right?
Up.
One went up with a debit, the other one went up with a credit, okay? Here, we did it this way before. So then we borrowed money, right? We borrowed money. Asset. Assets go up with a debit. Cash goes up with a debit. Notes payable goes up with a credit.
Credit.
And like I say, you're not going to learn these rules just sitting here today. It's going to take a little work off site to get these clear in your mind. Then the other one, he bought equipment, right?
Yeah.
He bought equipment. So you go into your journal, your general ledger. Remember that this blank screen is what you're going to see on your computer, whether it's in QuickBooks or in some big program like Mass 90 or Oracle or something like that. You're going to go into your computer system, say journal entry mode, and it's going to come up with the blank. And you key in the date, or your system automatically puts it in if you want. You key in the date, you key in your debit first, $5,000, you credit cash, $5,000. So get familiar with the journal entries, the general journals. For purposes of this course, that's how everything gets into the financial statements. Well, here they are. You've done all three of them now, and you even put an explanation down, issued stock, issued a note, bought equipment. Now we're ready to post. Now we're ready to post. You hit the button called post and whammo, that all goes into your financial statements, okay? Now we got some new transactions. Kate Brown's Beauty Salon. They issued common stock to shareholders in exchange for cash. They bought equipment, and then they interviewed 3 people for a position. The 3 activities are recorded as presented on the next slide. Well, we know that on the first one, the cash common stock, cash is going up and equity is going up in the form of common stock. We bought an equipment on account of nobody had money, so we know it's going into accounts payable. We debit equipment 4,800, we credit accounts payable, and we interviewed people. Issued common stock in exchange for 20,000. There's your journal entry. What's the journal entry for the next one? You're going to debit what?
Equipment up.
Yep. And credit what?
and credit
We're gonna pay for it later.
payable,
There you go.
accounts payable, yeah.
What's the entry for the third one? There's no entry here.
There's no, because it doesn't have influence on accounting.
Has no
Yeah.
economic impact. They could interview 100 stylists and nothing would go into the system, okay? Or another objective, explain how a ledger and posting help in the recording process. I told you this was a busy chapter, huh? How a ledger and posting help in the recording process. So we're back to our cycle. Analyze business transactions. That was what we were doing earlier. We journalize, and now we post. Now we post to the general ledger. We hit that button and update the general ledger. And then we're able to run what's called the trial balance, adjust the trial balance, financial statements, closing entries. For now, we're concentrating on the blue part, post to the ledger accounts. Think of your general ledger as a T account, a T account. The ledger is the books of the company. You've heard that. Each item in your chart of accounts, whether it's cash, supplies like you're showing here, notes payable, accounts payable, common stock, whatever. Each account has its own folder. So think of the general ledger as a book that has a folder for each account. And we're going to have it set up in a T account format where on the left side you debit, the right side you credit. Okay? The general ledger. And I hope they give us a good look at a general ledger. Here is the chart of accounts for this company. These are the accounts this company has set up that they wish to isolate in a specific folder, okay? For example, you've got notes payable, accounts payable, different types of payables here. You have different types of assets. You can go here, salaries and wages expense. You could have more than one expense. You could have salaries and wages expense, domestic, international, state, or something. So the red ones are the ones we're working with in this chapter here today. Here we go. Post the amount of the debit to the debit side and the credit to the credit side. This here is not the general ledger. That's the journal entry, right? We hit post, and hopefully it's going to go right to the general ledger. Posting transfers journal entries into the general ledger. Steps in the process: determine what type of account is involved, what decreased and increased, and translate these increases and decrease into debits and credits. I'm waiting for them to show us a general ledger. So here you go. Here is just the journal entry. These T accounts we're calling the general ledger. They're a poor man's general ledger. General ledger is bigger than that. A general ledger would have a double T account. The second T account would be for the balance. But for our purposes here, that's pretty clear. The general ledger is the T account. So here's the transaction. Cash went up, stock went up. We translate that into debits and credits. Cash increased, so did common stock. We hit the post button, and that's where these numbers came from here, from posting to the ledger. Posting. Same thing with the notes payable. Notes payable. We borrowed money. Cash went up with the debit. Notes payable went up with a credit. We now have $15,000 in cash on the general ledger. Now remember, we spent $5 to buy equipment. We spent $5 to buy equipment. So our cash is credited, bringing the balance back down to $10,000, but we got an asset for that money in the form of equipment. Yeah, I'm going to talk about the unearned revenue again. Knox received $1,200 in advance. The asset cash is increased 1,200. The liability, unearned revenue is increased because the service has not been performed yet. That is, when an advance payment is received, unearned revenue is a liability that should be recorded in order to record the obligation that exists here. A good example is I send the Dodgers $24,000 in January for my season tickets at Dodger Stadium. I wish, huh? I send in $24,000. They get that money. They can't call it income yet because they haven't played any baseball. So they debit cash and they credit exactly like you see here, unearned ticket revenue. And then when baseball games are played,
And
then
it goes into revenue.
it goes into regular revenue. Yeah. The baseball season is 6 months long. So if this was a baseball thing, 200 a month, you'd be debiting the unearned revenue and crediting regular revenue. I think that's getting a little ahead. I think that might be the next chapter. I'm not sure we go there in this chapter. Okay. So they're taking us through these different transactions. What is this? I can't read that. Oh, received cash from Copa Company. We perform services. So our service revenues went up with a credit, cash went up with a debit. So now we have a balance of what's that, 26,200. We have $21,100 balance in cash now. Balance in revenue is 10,000. Paid the rent. Cash went down 900. Rent went up 900. Insurance policy. Remember, you buy an insurance policy, it's an asset. Prepaid insurance.
Prepaid insurance.
It can't, the day you buy it, it can't be an expense. It can't possibly be an expense because it's for the future. Okay. So notice cash has a lot of activity there, huh?
Yeah.
They purchased, now they bought something on account of nobody had money. So it's going to be either accounts receivable or accounts payable. And since we're the ones buying something, our accounts payable is going to increase. So our supplies went up by 2,500. So did accounts payable. Whoa, Sierra hired 4 employees to begin work. They're going to make 500 a week. There's no transaction here. That's just behind the scenes work. Accounting may not even know about this hiring until the person comes in the first day of work and fills out her tax forms. Dividends, paid a cash dividend. A hard and fast rule, you always debit retained earnings. We're doing it through dividends in this book. You debit dividends, which is part of retained earnings. You debit dividends and you credit cash. Dividends are not an expense. Dividends is a giveaway of part ownership of the company to another person. Okay.
Stockholders' equity.
Yep. Part of the stock, you're giving away part of the stockholders' equity. The stockholders' equity went down by $500 by giving out that dividend. They paid the employees. They paid their employees. You debit salaries and wages expense, you credit cash. Debit salaries and wages expense, you credit cash, and you debit the appropriate expense, salaries and wages. So here they're showing you all the journal entries, I guess. These are all the entries we just wrote. See how nice and neat that looks? Notice the indentation. It means nothing to you right now, but if those credits were not indented, it would drive me crazy because that's what I'm trained to look for. And you always want to put the debits first, if it's all possible. It's not going to be wrong if you don't. But again, that's what the auditors are going to be expecting to see. If you don't follow those simple rules, that you're telling the world you're careless and you don't care about people who are going to try to read this information. And there is the end of our journal entries. So that's a look at debits and credits a little bit. You're going to have to study them on your own, memorize them as best you can. It's really just 5 things, remember: assets, liabilities, capital, revenue, and expenses. Here we go. Now look at our general ledger. Doesn't that look cool? Look at our general ledger. The balance of cash at the end of the period was 15,200. How did we get that balance? Well, we simply add all the debits, add all the credits, and subtract the difference. Cash has a normal debit balance, so do supplies, prepaid insurance, equipment. We expect to see debits. At the end of the month, if we have a credit balance of, say, 5,000 in cash, that's a problem. That means a mistake has been made that needs to be rectified. It might mean you're playing the float the check game, where you write a check even though you don't have enough money to cover it, in the hopes that you'll get a check in to cover it the next day from a customer. Or in the worst case, it means somebody's stealing from you. So cash better have a debit balance. Supplies, debit balance, all assets, debit balances. Payables, credit balances. Payables, unearned revenue is a liability, a payable. Common, look at your equity section here. The heading could say equity. Common stock, credit balance. Dividends, reduce retained earnings with a debit. Service revenue, credit, minus the expenses. Your revenue, which is 10,000 minus 4,900, means you made a profit of $5,100, and you're going to
The
move that
minus
number.
dividend,
What's that?
the retained earnings then has to go minus dividends too, right?
Right. When you,
Yeah.
I don't particularly like them telling you to debit dividends. It's not wrong. I think it means they're going to show the dividends separately within the retained earnings. We'll see. That's not a big deal.
Why they do it?
Well,
Showing
they
us
do.
the dividends.
They do it because they want to present to the public a little bit of detail in the balance sheet. You normally in the balance sheet, you see the common stock and you see the retained earnings, and that's all you really need to see. In this book, apparently, they're going to show the dividends on the balance sheet.
On the retained.
Yeah, you're going to
earnings.
see it. You're going to see it as a minus. In other words, on this balance sheet, you're going to see $10,000 common stock, 5,100 retained earnings for the profit, and then a minus 500 for dividends. And then you add them down, and that's your total equity, your total stockholders' equity. Okay. Hey, selected transactions from the Journal of Fitel Inc. They're giving you the transactions. Post these to T accounts. Why don't you take a piece of paper out for a second and just do it? Draw your T accounts. Draw 4. I guess you need 6 T accounts. The first one, cash. That's a debit, so that goes on the left side. That's what debit
So it
means,
goes
right?
up. Yes.
Left and right. So this isn't too hard on cash. I would expect to see a debit for 30,000. And what do we get a credit? What account do we get a credit for 30,000? Read the journal entry. We debited cash for
Common
30.
stock.
Common
no.
stock.
We credit. Yeah, stock.
Yep.
They go. up,
Right.
yeah.
You have to have at least one debit and one credit. Accounts receivable. We're going to debit accounts receivable for
The
6,000.
service revenue.
There you go. Good. Credit.
And was the service already done? Yes, because we have to
Yes.
do the service to receive the money.
Right. In this one,
Yeah.
we did do the service, they're saying. And then in the third entry, some of our customers are paying us. So what do we debit?
We receive cash from them. So our cash goes up.
And what does
Debit.
accounts receivable do?
And that way we have to reduce it from accounts receivable because they don't owe us the money anymore.
Exactly right. Good.
Yeah.
Now, let me go back up here if I may. There is our general ledger at the end of the month. What we are going to do now is we're saying that this general ledger is perfect. We're assuming that everything's correct. We're now going to take these balances. You see the 15,200, the 2,500, the 600. We're now going to put those balances into something called a trial balance. A trial balance. So here's what we've gone through today. We just did the posting section. Prepare a trial balance. Prepare a trial balance. And we'll get to those other guys later. A trial balance is simply a listing of your chart of accounts. It starts with cash, accounts receivable, then liabilities, then capital, then revenues, then expenses. It goes in that specific order, just like your chart of accounts, okay? And the only thing the trial balance does for us is verify that debits equal credits, something you're never going to have to worry during your whole working career because everything is computerized. So the trial balance is a very informal report. It's really a piece of scrap paper that we use to set up a format to do the financial statements. The purpose is to prove debits equal credits, and it may uncover some errors. We run the trial balance, and the first thing we see is, holy cow, cash has a credit balance. We got a problem. Where revenues have a debit balance, which is impossible. But mainly it's used to prepare the financial statements. So let's take a look at a trial balance. Sierra Corp trial balance as of, here it is. You just list the numbers. And where did we get those numbers?
From the T
We got them from the,
journal.
exactly right. We got them from the general ledger. We journalized them to get them into the general ledger. So we're picking up all those balances. And here we go. Notes payable is a credit. Unearned revenue, credit. Then we're probably going to see capital, common stock, dividends. See, they are showing dividends as a separate piece from retained earnings. And there's your revenue, and everything else is expense with debits. So, well, we ran this. Well, let's see here. The debits equal the credits. Does that mean these numbers are correct? The answer is no. Every one of them could
Not
be wrong.
necessary.
Every one of them could be wrong. We don't know at this point. We're going to go through another chapter when we talk about adjusting. But for now, we're assuming that these numbers are correct. So with that in mind, we can start to prepare the financial statements. A trial balance may balance even when a transaction is not journalized. If you forget to do something, you'll still balance. Even if the entry is wrong, it'll still balance. If you forget to post something, if you post something twice in error, incorrect accounts are used in journalizing, posting, or offsetting errors. So we're assuming everything is okay. The following accounts come from the ledger of Snow Gold Corporation. Prepare a general ledger in good form. So what they did was they mixed things up. So what are we going to start with? What goes first in your trial balance?
Cash,
Assets, then what?
liabilities,
Keep going.
and stockholders' equity, where
And
stockholders' equity is from common stock, retained earnings, and those are from the revenues minus expenses minus
there you go.
dividends.
Perfect.
Yeah.
So let's take a look at this together here. Let's see if we can find all our assets. I'm starting on the upper left. Equipment is definitely an asset. I see accounts receivable, that's an asset. And I see cash. Okay, looks like we have three assets, right? Equipment, accounts receivable, cash. What order do we list those three on the trial balance?
Liquidity
Liquidity. Cash is liquid already.
is first.
The next liquid item is AR. There you go.
Accounts receivable.
Yeah. So what comes after this? We got to look for the liabilities. I see accounts payable. I see salaries
payable.
payable. So we have 3 payables, okay?
Notes payable, yeah.
So they should be in this order here. Accounts payable usually comes before notes, but that's okay. So now we go back and we pick up our capital. Capital.
Common stock. Oh, yeah.
I see common stock. Do I see anything else? I see dividends, huh?
Yeah, they go under retained earnings.
Yep, yep. Notice that the dividends are a minus. They have a debit balance, right?
Yes.
So our total equity is 12,000. And then you pick up the service revenue and the expenses. And that's all there is to it. Now on the test, you'll be given a problem similar to this, where they ask you to fill in a few numbers. They'll ask you to put together a tiny little balance sheet. It might be a problem where it's a fairly big problem, but since the test is multiple choice, the next 5 questions will come from that information.
Mhm.
We're not going to worry about IFRS. And that's the end of our presentation. That was a busy chapter, wasn't it? That was a busy chapter. Does anybody have any questions or anything?
Oh, I have one, but it's about tutoring.
And who's talking, please?
Serena.
Serena. Okay, could you speak up? What's your question?
So is tutoring Mondays and Wednesdays?
Tutoring I'm tutoring. Let's start with Monday for sure. I tutor from 10 to 12 on Monday and 3 to 5 on Monday. And I will be in the tutoring room. So you can come see me in person if you want, but I'll also Zoom it on Monday in the afternoon and evening, okay?
Okay. Also, is there tutoring tomorrow too?
Tomorrow's Wednesday. I don't believe I have tutoring tomorrow.
And then Saturday at 9 a.m.
Yeah, because on the pipeline or like the homepage, it says Mondays and Wednesdays. I was kind of confused.
It says Monday. Oh, okay, that's my screw up then. So you were looking for me at 9 o'clock this morning?
I was looking
No.
for you yesterday.
Okay. Okay. I got to get my schedule down. That schedule might change. I don't want to use the word complain. I was discussing those hours with my boss. There are some hours where no students ever show up. For example, they've got me tutoring on a Friday. Very rarely do I get anybody come in on a Friday. So I'm telling Cornelia, maybe we don't need the Friday. Maybe we can just cancel that. Maybe we don't need Tuesday and Wednesday. So as soon as we finalize the tutoring schedule, Serena and everybody, you'll know about it very clearly, okay?
Okay, so
So you're
when
telling me that tomorrow I'm tutoring at 9 o'clock, huh?
well, it says 10:30.
Oh, 10:30. That's right. I have my classes tomorrow. Okay. Thursday, I know it's 4 to 7.
Okay.
4 to 7. 4 to 7, I like to take a ride into school and be on campus for that. Again, you can come in and see me in person, which is the best way to do it, or we can Zoom, okay?
Okay, so tomorrow will you be doing the Zoom?
Tomorrow is Wednesday and I will be Zooming.
Okay, and it's the link on the homepage.
Yes, the Zoom link on the homepage. I will also be in person though.
Okay, thank you.
Okay. Any other questions?
No.
All right. Well, I think that was enough for one class. I would say we were pretty busy here.
Yeah.
So you got some work to do, guys, okay?
Yeah.
And I'll let you go. So take care, everybody. We'll see you on Thursday, okay?
Yeah.
Bye-bye.
Bye-bye.
Take it easy, Laura. You must have had too much of debits and credits for one day, right, Laura? Okay, bye-bye, everybody.